Great. So thanks everyone for pitching up to this session. We're going to be talking with some great guys from within the industry from a few different angles about how to prepare yourself for exit, what to expect, and how the whole process works and generally. So I'm Martin Macmillan, I'm the founder of Pollen VC. We're sponsoring the track. I'll maybe just let everyone just do a very quick intro, and then we can dive in.
Yep. Hi everyone. My name's Julian Au. I work at Aream Co. Aream Co is a gaming-focused investment bank, advising founders and boards on fundraising and sell-side M&A. So in the past, we worked at Peak Games, Small Giant Games, Gram Games, Hutch Games. On the mobile side, on the PC console side, we've advised Behavior here, JagX, Unknown Worlds, and also Kixeye, who had a studio up in Canada. Personally, I've been with the firm for 9 years now, and these days lead the North American initiative.
I'm Jean-Sylvain Sormany. I'm a studio head and co-founder of Snowden Studio. So it's a studio that we co-founded in 2010. The reason why I'm on this panel is that in 2018, we were acquired by a large company called Keyword Studios. And since our acquisitions, we went from the 25 employees at acquisition time to 200 today.
That's just an incredible story. That's amazing growth. Hi, everyone. I'm Ryan Black. I'm sorry for coming in late. I was just speaking in the other room and had to run over here. I'm a lawyer at DLA Piper, which is a global law firm with offices in 40 countries and about 4,000 lawyers worldwide. So there are a lot of game studios we act for. There's a lot of publishers, devs. But I personally work in the startups emerging company space. So I tend to work on the sell side usually with companies that range from indies to full-sized AAA studios and pubs. So I've also worked on quite a few M&A deals in this space, and happy to share my thoughts.
Cool. So maybe Julian, sort of kick off with you in terms of keep it wide to start with. And, what are buyers looking for now? Obviously, there's changes in the market, but from a very high level, what is it really that that creates that chemistry for a deal to happen?
Yeah, look, thanks, Martin. So I think M&A is all about alignment between what the seller is looking for and then what the buyer is looking for. And if we think about even in this market or 2 years ago, there's maybe three main things that buyers are looking for. First thing mainly is kind of ideas, IP. Ultimately, this is a creative industry. It's hard to come up with new ideas. Larger publishers like to say that they're diversified. So acquiring new IP and games is one way of doing that. The second one is maybe scale, so financial scale or user bases. The larger scale a game, the more proof points you have that the inherent risk is reduced. And then third is new segments or new businesses. So this is an evolving industry. Things change. Maybe they want to move into a new genre or new platform, and that can drive M&A as well.
So I guess for Jean-Sylvain, the same question, almost another way around. When your transaction happened, what were what were the sort of key reasons you were acquired?
In our case, the acquisition company was looking at talent and capabilities, being able to scale up what they were already doing and doing it better. And we see this more and more, right? In the current ecosystem, a lot of companies are just scaling up. Like Microsoft acquisitions spread is really just about building up their Microsoft catalog, being able to grow more. In our case, Keywords was a service provider. They are basically fundamentally growing by acquisitions. Often we say when we go into a period where there's a lot of inflation and everything, we see a lot of those acquisitions. So you see a lot of those acquisitions being done, so we can basically confirm our position in the market and really make sure that we are the player. And this is something we see a lot.
And maybe Ryan, maybe less directly relevant for you from where you're sitting, but obviously, you've just seen a lot of things go through. So, when you'd be on the other side of the table at 11 p.m. trying to get the deal done, what do you see as the primary kind of motivators for these transactions to happen?
Yeah, I think there's sometimes different motivations. I think it's really important to know, if you're a studio, who is your buyer and what is their motivation. I mean, a financial buyer is very different than a strategic buyer in what they're going to want. A strategic is looking for, I think, a lot. What we were saying here is about, having lots of strategic add talent, grow, add revenue, maybe bolt on some revenue in a market where you're trying to do it. There's a number of reasons why a strategic might do it, and that might command a higher value or more opportunity than from, say, a financial investor who is going to definitely want a very quick return on their money, and they're going to want their money out. And I know on the investment on the banking side, you guys must always talk about, what are the buyers really after here, and trying to drill into that really makes a big difference. The biggest trend I've seen in Canada is that Canada has just an amazing talent pool. We have a lot of dev shops up here. We have a lot of really good talent that is relatively cheap if you can qualify for some of our tax credits. Although we are seeing other markets emerge that make it a little bit cheaper. And I would like to see Canada catch up a little bit on the tax credit side. But generally speaking, we have a lot of talent. And so having a good team actually commands a lot of value right now. There's a real talent crunch out there. And I think that's one of the bigger drivers that I've seen.
So when is it time? You don't just wake up one morning or maybe you do. Did you just wake up and think, you know what? I think we're in a shape that we're looking to sell, and do the next thing, or do you get approached? What makes the ground shake, if you like, for a transaction to happen? Maybe to Jean-Sylvain first.
So I think it's always important to always have an exit strategy in your mind. You shouldn't be caught by surprise when it arrives. So one of the first things you should do almost as soon as you have your business plan is to think about what could be my exit strategy. It doesn't mean that it will happen for us. It took a decade to happen, and it's not like something we were always thinking in the back of our mind. But it's important for you to be prepared if it arrives and to understand your motivations to sell. I'm still working at that studio. I didn't sell, so I could start a new venture or something like that. But this is very specific to what we were doing at our studio. I sold so I could have a mean to scale and to do more with more influx. We sold at a point where growing was painful. By being acquired, we had a full structure of the support, IT, HR, everything that was allowing us to accelerate our growth. For other people, and we were just listening to those indie people, it could be for having more the means of doing what you have to do. And it doesn't mean that you have to completely sell your creative mindsets to this organization. There are some deals, like if you are purchased by Netflix, you may sell all your creative needs. But if you are purchased by Microsoft, for instance, like the people that bought the We Happy Few studio and Compulsion Games, they still retain full ownership on what they're doing, and they're still remaining in control. They picked their acquirer because it was in a fit with them. So my advice is think about, if you were to sell, what would be your motivations, and try to find that match. But you don't have to find it actively. It will find you once you are successful and you're ready to be sold.
Cool. So fit very important, and also what comes next. In some ways, some people may just want to take the cash and toss them the keys. Thanks very much. But in your case, it was to have an environment that you could kind of grow into, but would take care of some of the growing pains of all the other infrastructure, so you can keep kind of focused on what you're doing. Cool. Ryan, maybe on the okay, same question, a different way, Dave, way to you. So from a more sort of transaction standpoint, what things need to be lined up?
Sure. One of the key things to realize is that an M&A deal really does kind of lift the tablecloth a little bit, and you get to see everything going on, all the rubber bands and glue holding your company together. When you're doing an M&A, that actually all gets exposed pretty quickly. And one of the key things that we work with our clients on is making sure that they're disclosure ready. And by that I mean, someone is going to be knocking on every door and kicking every tire and making sure everything is. I'm sure you've been through the process, Jean-Sylvain. I'm sure you know just how intense due diligence can be, and the number of questions that come.
If I can just give you an example, we didn't think that it would come, but like at some point they're looking at your software license and what are you using as software? Like, is it all legit? Are you like using like copies of a software? Like, and it is flagged at some point at risk and say like they check every single thing. Yes.
Yeah. So I mean, it's hard to overstate just how much vulnerability you will experience during an M&A process. You know, a buyer is going to come in and start looking and you know, really kicking the tires. And so for that reason, it doesn't mean everything has to be perfect. You don't need to be the perfect company, but you need to be able to have a story for all of your disclosures. So like, let's say, for example, that maybe there was a period of time where you didn't quite have the right software licensing, and so Adobe or Autodesk or whoever it was knocking on your door and asking questions. They will ask you, hey, have you ever gotten a letter about this? And if you try and hide it, that's going to work against you. One of the key things that I think people don't realize in the M&A process is that disclosure is your friend when you are on the sell side. Disclosure is what protects you. By telling the buyer, hey, this happened, you're setting it up so that they can't come back at you later and say, but you didn't tell us about this, right? And so working with your advisors who understand the process on the investment banking side, on the accountancy side, and on the legal side, HR, all these other issues, making sure that they know what your issues are so that when someone comes and asks all these questions, you actually have a good answer. That's much better than running a perfect company. If you can run a perfect company, just keep it as simple as possible, right? Keep your share structure as simple as you can for as long as you can. Keep your tax structure as simple as you can for as long as you can. Don't try to get too cute with all of your planning before an investor comes in, because when an investor comes in or when a buyer comes in, they tell you what structure they want you to use, right? Like they're like, we understand that you've set yourself up this way, but this is how we're going to buy you. And then all of a sudden now you're scrambling to fix things a little bit. Now, of course, some sellers are in a position where they can really negotiate that stuff. But on the smaller end or on the junior end, and if you're mostly talent, you're going to have to really sell your company. And doing that means having a story for all the warts and hairs that they'll find when they start looking.
So do an element of diligence on yourself on an ongoing basis, not just like leaving it all and then right to the last minute could derail the process. Julian, what do you think in terms of obviously you work with a bunch of venture-backed companies and so on as well, and I can imagine a certain amount of kind of jostling when either they think or founders think, or when it just kind of feels right. Maybe you can talk to the sort of investor dynamic and maybe some of the metrics and so on that you see the ground start to shake.
Yeah, absolutely. So I think Ryan and Jean-Sylvain are right. Everything in the company needs to be in line. Absolutely. You can't sell a company if it isn't. And the buyer has to be there. The buyers have to be interested, and you have to find the right buyer fit. But the other thing that might dictate timing is, the shareholders, and whether that is the founder or VC-backed companies have investors as well. You'll each have your own kind of motivation. So, we work with a lot of founders who maybe they've been through it for a while. It's just time for them to sell. They have a lot of personal wealth. They're locked up in this company, and it's just the right moment. But otherwise, with VCs, they have their own fund timelines and things as well. And maybe the value that they are indicating the company might receive in an M&A transaction is enough for them. So we see a lot of those situations, and there's different ways to align, but sometimes you just can't align, and you have to find the right deal structure that can satisfy both sides. Well,
I guess that's part of your job, is to bring everyone around the table when you're doing the rainmaking, right?
Exactly. Yeah.
Cool.
A little bit.
And so in terms of the things that you should do, Jean-Sylvain, you mentioned about thinking about always having a story, right? So don't be like, one day you get an approach and you're like, oh shit, I didn't really think about that. So always having that story. Do you think there's a sort of an element of kind of doing that storytelling sort of on yourself, the sort of like the bigger picture messaging thing that you're trying to achieve at that point? So how do you go about making yourself attractive? So making yourself discoverable, or what sort of things fed into that process for you?
I wouldn't spend too much time making myself attractive to others. I would mostly encourage everyone to be successful in general. And that's probably going to be the spark that will generate the story itself. So first, work hard to be successful, and make sure you build something that you are proud of, based on your values and don't go against your value. Like follow your value, your core. Like we had a company, we always said like it's employee first. We have no crunch policy. And for us this is important, and this was like always in part. At some point it came without us knocking on any door. On the same year we had three potential buyer coming to us without us looking around. They were just saying, hey, you're that quite successful studio. We're interested in what you're doing, what you're offering. Are you interested? We engaged in discussions. The first discussion were just like a no-go for us. We were looking at it, and not a right fit, not exactly the right place we wanted to be. It was interesting, but not exactly interesting enough for us to go into the process of due diligence. But at some point, it was just not the right fit. And then we found that company that was basically just a culture fit. We loved everything we heard about it, and then this was sold. So there wasn't us preparing for this. It's them knocking at the door. I remember like someone just sent me an email saying like, this is very left field for you, but are you interested in having this discussion with keywords? I said, well, might as well have a coffee first and we'll see. And we had a coffee, and then I had a chat with another seller in that another company that sold to that company, and then a second chat. And at some point, like I started like making the story that it could work, and it could work respecting our values and where we were.
Right, so fit very important, but don't spend too much time positioning, get on with a day job, and then they'll find you.
That's my experience. I'm not sure if there may be stories of people that wanted to sell.
These guys are nodding too, so I'm going to take that as best practice.
Well, look, I think it is all about if your exit story is I'm trying to exit for a giant value so I can retire, get out of this business and retire or something. That's going to motivate you very differently than if you're trying to build a studio. And I actually really like what Jean-Sylvain just said about building something that you're proud of. I think that's actually one of the key things in this industry is that something that even buyers are hungry for, which is authenticity and the ability to actually have a studio that you're proud of, have a game that you're proud of. I think of some of the deals that I've worked on in the past with indie studios, with games that blew up for one reason or another or got really popular, and you'd be surprised who the fans of those games are. Those fans might include your buyers, right? Like we worked on a deal once with an indie studio that actually got the attention of Nintendo simply because one of the heads up at Nintendo really loved playing the game, and that resulted in some pretty positive interactions for them. Another example of I think a studio that's done really well with just making excellent products is Clay out in Vancouver, and that's led to a lot of success for them. If you focus on the product, I think a lot of good opportunities come. The other thing I would say though is that the wrong buyer doesn't care about your game, right? If you're telling that story, I love my game, I love my studio, I love my team, and they're looking at how much can I sell this for 3 years from now, you're going to have a mismatch in the M&A process. But for a strategic buyer, that could be a really big fit. So knowing what your story is really, really matters.
And then, Julian, on the financial side, then how if we take the sort of the strategics, to one side, and you look at more of the financial buyers, how are they looking at it in terms of kind of metrics and KPIs, and how should founders think about how an investor, how an acquirer is going to perceive them?
Yeah, so I mean, obviously a financial buyer will look at financials first and foremost. I don't disagree that you always have to do what's right for the business and what's right for you in terms of building an enterprise that you're proud of. But of course, if you turn off UA in the 3 months before a sale, it might raise some eyebrows. So I think the financial profile, the trends as you get closer to your planned exit, super important. If you think about some other types of financial buyers, for example, private equity, maybe they're thinking about bolt-on acquisitions in the future. What kind of roll-up play can they do? So maybe they are looking for a team that can lead that, or play a part in some kind of larger entity that they want to build. So I think there's a different set of considerations compared to strategic buyers.
So, and then in terms of timescales, so you had some ideas around, to this idea of sort of diligencing yourself over time. What sort of things can you do earlier in the process as a sort of like a 3 years, 2 years, 1 year? If you're, no one can plan perfectly for multiple years in the future, right? We all know that. But if you were to if you were to sort of like think, from the early days, what am I setting up? What, how should I look, and what kind of diligence hygiene can I do on myself on a, albeit low-level basis, just to make sure you're, because like most people that do this want to ultimately have some form of crystallization, value creation event, whether they stay on and it's, they get to do that within a bigger environment, or they just take the cash. But so what maybe your thoughts on what and when, and what a sort of a perfect timeline would look like.
Yeah, absolutely. So I think if we talk about multiple years out, 3 years out, you think about things that take longer to achieve, right? So if you have multiple legal entities and no holding company or something, that's going to be a difficult asset for someone to acquire. So, straightening that out is one thing. Your accounting policy, maybe it's one that most buyers aren't sort of familiar with. Maybe that's something you need to change. We work with a lot of studios that have gotten on fine without any kind of monthly reporting or financials. Maybe they don't have investors they have to report to, so they just don't have these ongoing processes. And I think those things are the kind of things you need to think about, like multiple years out. And
then, Ryan, maybe like, because you're going to see stuff a lot closer, right? When it's like, all the legwork's been done, and then you're going to see it sort of, when it's transaction time as well. What would you advise? How would you advise folks to think about that?
Yeah, I mean, it's a very long. First of all, M&A is a very long process, and so you're getting ready from a very early stage. And I think in the short term, some of the things you can do is like making sure that I'll just use a war story as an example. I've entered many an M&A transaction only to find out that my seller doesn't actually on paper own the things that they're trying to sell, because a developer set it up before the company was set up, and so the app account is in the name of something else. Or the domain name isn't registered right, or the social media handle isn't registered right, or whatever it is. And when you're selling something, you actually have to have things to sell. I know that sounds trite, but this can actually be sometimes pretty complicated, particularly if you've been in startup mode and you've just been getting things done. When you set up your bank account, you weren't necessarily thinking about someone was going to come in later and look and want to take that bank account over. Or when you were setting up your app store, you weren't necessarily app developer account or something like that. You weren't necessarily thinking about someone's going to want to take this from me later. And so you've just been getting it done. And so you can't really be too early in thinking about how to kind of wrap those things up. But on the other hand, M&A will take a lot of your time and effort. It's a very long process, and I'm sure, having been through it, Jean-Sylvain, you know that once it starts, it's quite a drag on the rest of the business. So like there is a pressure to get it done, and it really takes a lot of attention. And so the more you can do to spread that out over time by starting early and just picking off the little low-hanging fruit, the worst time to go out and ask. For example, the worst time to go out and ask one of your developers to sign an IP invention assignment agreement to make sure that you own the property that you want to sell. The worst time to ask is right before someone's about to hand you a big, bag of gold, because that developer might say, "Great, I'd love to sign it. How about some of that gold, please?" So you have to be a little bit thinking about these things in advance.
The only thing I would say is that trust that there are also advisors you can get to handhold you through that process of M&A. Like I'm not just speaking for those two person, but if you are surrounded by the right people, they will help you. Like when we sold, we didn't have a holding company, but we had to quickly start one so we could move cash out of the company, so it would be excluded from the. And frankly, it's like all thing that like. If you are an indie, you're not necessarily thinking about the fiscal structure of an holding company and things like that. And frankly, we even made a mistake because we did it quickly and we created an old co for all the co-founder. And then the year after, we had to pay again to resplit that old co into individual old co. But like, you have to think about, you don't have to do everything alone. You can basically surround yourself with the experts. They will help you setting up what you need in order to sell properly. And And frankly, in my case, yes, it was a long process, but it wasn't painful because I felt we were supported the entire way around, and never it was particularly stressful or even a drag on our company because we were so well supported that we could continue our operation normally.
So with the exception of obvious exception of good bankers and good lawyers, who's on the stage? Who else do you need around, basically, to help you sort of manage that process? And it would be different, obviously, in different jurisdictions and so on. But what were the roles fulfilled that were sort of helping you through that process?
So there's a few people. First, you need someone on the fiscal side and on the accounting side. So these are usually two different specialists that will help you. So someone will think about the tax implication, and the other one will and the structures of what you're building. The other one will be more like on the purely accounting and reporting to the seller's company. You need an advisor, just someone that has gone through a couple of M&A process and can basically tell you, is this a good offer? Is there a thing you should negotiate more? Because when you go into an offer, it goes down to renegotiating a contract employment with the new person that you're not anymore your employer, so you have to renegotiate those things. Then the rest is really depending on what you're building. But like if you have like IPs and things like that, you may want to have like people that are experts in that field to support you. That really depends on what you're doing, and make sure you have like a long and good discussion with your shareholders and your board of directors, so everyone is aligned and everyone knows what they want and if they want the same thing. And in our case, like the motivations for the exit strategy, we were three. Two out of the three wanted to continue growing the studio. The third one was looking for an exit strategy. You better clarify that before the end so you can have this transparent discussion. You said it at the beginning, like importance is transparency. Tell your person that someone will be leaving the company as soon as possible. In our case, we set on a delay of 1 year, so we could make sure that there was like a smooth transition. But one of them was out after 1 year, and the others are still there.
I'm getting very strong threads of alignment, transparency, through all sorts of different aspects of it. So, Julian, when you guys engage, obviously you're not you're just there for the transaction. I guess you like to build relationships and earlier on and add some value along the way, maybe have some sort of like tacit input into some of those conversations as well earlier on?
Yeah, absolutely. And this might be something that people don't realize, is that you don't have to hire a banker just for the transaction as and when it happens. I'm sure you've all seen the corp dev guys from the large acquirers of lurking around these conferences all the time, doing outreach, asking you for KPIs. And even from there, advice on how to handle those conversations, how to politely say no, how much to divulge. Those sorts of things are things that we can, advise on in the background even, or just informally. So I think going from there, maybe you have investors or a board and they want to know, is this year the right year to sell? Is the company in a good condition? That's also something that we can help with in terms of providing insights.
So build those relationships early. Ryan, does that go the same for lawyers as well?
Yeah, I think so. I mean, I actually give a lot of talks to startups and emerging companies group about how to use their advisors properly, just because from the lawyer's side, lawyers have a reputation, if there are high hourly rates and billing structures and like that. And it's true, we're expensive. But good advice is expensive and is valuable. And it's always frustrating to see a deal where there's maybe a banker on or an accounting person on who's charging all these high fees or maybe taking a percentage of the deal, but doesn't understand the industry, doesn't understand your business very well. And you spend most of that time and effort actually educating them on what you are and who you are. So building a relationship over the long term is so powerful. Like some of my favorite clients are ones that started with a couple of people in their basement building something, and then they get acquired 5 or 6 years down the road, and I've been with them the whole time and I understand the business. So when the sell comes, number one, I'm not surprised by it. Number two, we're a little bit ready. And number three, they don't have to tell me about their business so that I can negotiate with the other side and work out some terms. When I see a purchase agreement come across the table from the buyer, and I look at it and I say, well, this doesn't align at all with my client's cloud live services. They're looking for something that's a little bit more static and discrete. That makes a huge difference in the on the friction or the frictionless nature of the deal. And so I think it's really important to use your advisors properly. There's nothing like good banker advice on a deal. Like the experience and what they bring to the table. There's nothing like good accounting advice on a deal. When the accountants tell the lawyers, here's exactly how we want to structure it, here's the tax consequence, everyone's happy, it just allows us to do our job so much easier. And so I think it's really, really important for the advisors to work together, but also to work with the business to understand them really well.
So, so we've got a little under 10 minutes left, so now we can get to the juicy bit of what mistakes have you seen, or what mistakes have you seen, obviously on a no-names basis, and what sort of things keep coming back up from an advisor basis, and then maybe for Jean-Sylvain, like what do you wish you'd done earlier in the process? Was there something that you thought, if I had my time again doing this, then I would have thought about it slightly differently? I mean, it actually sounds like you had a pretty thought through kind of process.
So in our case, I think it went very smoothly, and there's not a lot of regrets looking back. One of the difficult part of it, though, that I can see, and we had actually no clue, is what was our valuation, right? How do you establish your own valuation? And I think that's probably a common mistake for a lot of company to set a wrong valuation to their company. Typically, I've learned through the process, and basically we had to consult with a lot of people that usually, and that may depends on your companies and really some of the potentials, but companies are looking to get back their investments within a 3-year time frame given your current track progression. So essentially, in our case, we were doing maybe something like 1.5 million a year, and it was like from 1 to 1.5 in the next few years. They looked at 3 years and they offered like 5 million, saying, okay, this is your evaluation for the next 3 years. And when we consulted, everyone told this, yes, this is fair, and this is a fairly normal way to evaluate. Of course, we did more than that in the next 3 years, but it doesn't count because and you shouldn't have regrets because this is the support of the parent company that basically was an accelerator for us. And today we're making like close to 16 million a year of profits, and this is just because we have a company in the back that is promoting us and supporting us. It's easy for us to regret saying, oh, I could have made 16 million a year and I sold for 5 million, but the reality is that I'm not sure I would have done this, and I wouldn't have taken the same risk. When it's your company, you're way more conservative than when you're operating for another company where they tell you, yes, take the risk, go fun. And a lot of companies are acquiring because they see the entrepreneur in you, and they see that if they unleash that, you will succeed in many ways. So from my point of view, the biggest thing is try to think about a valuation that is reasonable. Don't think that your next project, because you believe in your next project, it's going to be successful and everything. This is usually something that like people that do the acquisitions are not really high risk taker. They want to make sure that it's a safe investment. So build your track record and make sure that you can defend your valuation.
Cool. Julian, in terms of mistakes people made or regrets or things that you would advise them to do differently, whatever, what are the key things that keep coming up?
Yeah, I mean, obviously we like to think that we don't see too many mistakes when we're involved, but I think one thing would be if you have an acquirer coming to you and asking for KPIs and things and numbers, and then asking if you're willing to sell, and they look at all your metrics, and then they pass, then you probably can't come back to them in a month and say, okay, how about now? There's probably going to be a period at which you have to wait before you can credibly come back to that buyer and say, hey, the business is evolved, can you take another look, would you reconsider this? So I think it's about managing that provision of information early on, and then also just timing. Like timing is super important. Is it the right time now to approach these buyers? Do you think you have interest from multiple parties to create a competitive process?
And do you keep the relationship sort of open in that period of time? Or do you just go dark and then come back to them? Or how do you manage the flow of information in the meantime?
Yeah, I wouldn't say you have to go dark. Acquirers will always be there. They'll never turn you down because you haven't seen them for a couple of years. But I think it doesn't hurt to say hello at a conference like this to them, even if you have nothing, immediate that you want to sort of transact on with them. It doesn't hurt to keep the relationship alive.
Cool. Nice little plug for Pocket Gamer there. Ryan, you've pulled the late night seeing stuff coming out at the last minute.
Yeah, I try not to. I've shared a couple of the war stories already about waiting a little too long to button up some loose ends and it being very expensive. I think what I would say is one of the key things you want to do is understand why you're doing whatever deal it is, whether it's an investment or whether it's an acquisition. Understand why you're doing it, and then follow money from there, because money really is. I don't want to be too, I don't know, overly capitalist about it or whatever, but generally speaking, money is how people show value, right? And so if you watch the flow of funds, if you watch the way that the buyer structures the deal and you follow the money, you can actually see where the value in the deal is coming from. And sometimes I see some mismatches there. So like if you're a very aspirational company and you're pitching on your hockey stick, so you've had a period where you're down and now you're pitching on this, look at how awesome we're going to be because we've started to rise. You're going to have to deliver on those things to your buyer. And if you're a little too optimistic about that and the deal is structured in the wrong way, that's actually going to affect your value. Whereas if you had not been so optimistic and the deal had been structured in a different way, maybe you could have gotten a little bit more. So understand why it is you're doing. The last thing I would say is a few years back, I worked on a couple of deals kind of back to back. Both were very large technology exits. But in one case, there had been, 4 or 5 rounds of investment before the exit. And in the other case, it was a completely bootstrapped company. And I can tell you that when you're doing a deal and you have sold little bits of your company along the way, you've gotten investors, you have to look out for, as a founder, as a director of your company, as one of the key shareholders, you have to look out for those other investors as well. And they're expecting, their returns also. And it's quite different to watch someone who has full control over a business go through one of these M&A deals as compared to someone who has already had a few investments, has a sophisticated board now, has had to do all the financial reporting, has had to deliver on some metrics, has had to deliver bad news to their investors, all those sorts of things. That the difference is quite astounding. And there's benefits to both, but just know which one you are, and it's really going to define how the deal goes.
Cool. We have a couple of minutes left. I don't know if we want to throw it out. Maybe we can do one or 2 questions at the end. I don't know if anyone's got anything they want to ask whilst we've got the guys here.
Cool. Does anyone have any specific questions they want to ask? Back up. Let me just pass you the mic.
Thank you. Yeah, hi, I'm Falco. So in the games industry, you have a lot of these like revenue coming in waves whenever there's a new game. And you already mentioned developers, of course, believe in the next game. But how do you deal with that when it comes to the valuation of the company, where like every developer will always say it's the next big thing, right? It's gonna do 10x better than our previous game. Is it all earnouts, or do you have to wait for a better moment in time? Like, how do you deal?
So that really depends. If you are a risk taker, you can always structure your deal so the revenue from your next title is part of the deal, right? You can have like optional component into your deal, saying like, if my next title make over X sales or X in revenue, then I get a quote unquote bonus on my sale. That so you can structure your deal to take advantage, but you have to understand that you're taking the risk at that point. And so you set a base value for your company, and then a percentage that goes on top of it if you deliver on the promise you did. So if you are comfortable with this, and if you're really, really sure that your next thing is disruptive and will change, you can always have that structure. Please know that every acquisition is unique, and you can structure it in a way that it works for you. So if that works for you, that might be the options.
One of the best pieces of advice I ever saw from a VC investor was that, like, when you're pitching your idea to a buyer or something like that, you have to be able to back it up to some degree, because if what you're saying is, I have a great idea, and if you give me your money, we can build it. If you're saying that, the alternative is for this person to just take their money elsewhere and build it, right? And not necessarily what you're doing. I mean, confidentiality issues and all that sort of stuff. But you never just want to say to an investor, I need your money so I can, right? And then, so like, I think it's really important to make sure that you understand why it is that you're attractive. Don't assume that because you had a hit game that the next one's going to be a hit unless you know why it was a hit, right? If you know why it was a hit, then you can tell the investors, and that will help assure them that the next one's going to be a big hit. But the sophomore slump is real. Sometimes a company that has a really successful game, the sequel comes out and it's not as it doesn't hit as well. And it may just be because the market's changed. It may be because the studio doesn't understand why the game was successful to begin with, or what made the first one so valuable. But if you understand that story and you can pitch that to an investor, that might really help you.
Cool. Well, we are out of time, but I think you guys will be around for a little bit if anyone wants to come and grab you and ask any specific questions. So, and then I will be giving a talk shortly on a framework for valuing mobile gaming studios. So if anyone wants to stick around for that, then it might be a little bit controversial, but we'll see. So big hand to the guys. Thank you very much for taking the time.